Welcome back to the Real Estate 401k Show. I'm your host, Mike Weinstein, alongside Justin Frederick and Ryan Gerdes. You're going to want to go ahead and text the word bad idea to six. No, I'm just kidding. How about idea or bad? Very bad. Text the word idea to 623AZ Recon. That's idea to 623 AZ Recon. Obviously, the last couple years, one of these days we're going to look back over, COVID and then just the last 4 years of real estate. And I don't know if we're going to really quite be able to describe it in a single sentence. It's just been interesting, and sometimes people are up, sometimes people are down. But the truth of the matter is there are people out there struggling, and we see it every day. And so one of the solutions, Justin, that people are using in order to pay their mortgage payment or pay their rent, trying to avoid foreclosure, trying to avoid eviction, is to dip into their 401k programs. And obviously the 401k program is designed for retirement, designed to help people when they no longer want to work.
Not the real estate 401k program.
The real 401k, yeah.
The traditional one.
The kind that we're not licensed to help people with.
Right.
And so there's this thing that's called a hardship withdrawal. And obviously it comes with penalties, and it's a loan. Are you seeing this, and what are your initial thoughts?
So we see hardship withdrawals. It's called hardship withdrawals, but we see hardship withdrawals to purchase homes with, which I 100% agree with, because you're taking one asset into another asset. It's one investment into a different investment. But my thoughts on it are, if you're dipping into your 401k just trying to get by, and there's nothing like, maybe you're on a leave of absence and you're dipping into your 401k. I'm okay with that. Like you have an injury, you're out of work, you need to supplement your income for a little bit. But if this is an ongoing issue and you're having to withdraw from your 401k, what's going to change to keep you from dipping into your retirement?
Yeah,
right.
Is there a plan to pay it back?
Right. And I don't agree with doing that. If you're trying to just get by dipping into your 401k, because we know what's inevitable. You're going down a tough road already. You're removing assets from yourself. That's not a good idea.
So I because this got brought up because we were reading this article earlier this week, and it reported that in 2023, it was up to 39% of people holding a 401k from the people that were pulling from their 401k for hardship, up 8 points from 2 years prior. So let's do some math here. 2020, March of 2020 is kind of when COVID went into full effect, and then 2021. Then we were deep in it by then. And so there was a lot of legitimate hardships, but there was a lot of money spending, and inflation was on the rise, but also interest rates were just rock bottom.
Stupid low.
Right. And so people were able to refinance, but still they're at 31% 2 years earlier. And so now they're talking that we're lingering around that 40% marker. What do you think changed?
I honestly think that just human nature is to keep up with the Joneses, and I think what's happening is people are overextending, and this is what we see on our end typically. Is people tend to spend money before they even actually get raises. You see somebody get a raise, and before it even goes active on their paycheck, they're buying a new vehicle. And a lot of times what ends up happening is we see that, then we see them shut down, taking money from their paychecks to their 401k. And then the next step is actually withdrawing funds from the 401k. That's typically what the road leads down.
Do you think it's a derivative of increased interest rates?
I absolutely think that, credit cards have been, you used to be able to keep a balance on your credit card in 2020, and your minimum payment wasn't too bad. Now with interest rates going up, you see carrying a balance on interest rates. We see credit reports where these payments are much higher than they used to be at these balances.
But I think it's a lot about doing math. I mean, there's one aspect to do a hardship withdrawal to pay your rent. And I don't even want to comment on that. But the other side is doing a hardship withdrawal to pay your mortgage, to ensure that you make your mortgage and so forth. And we talk about, do you have a plan to pay it back? Understanding that most repayment periods are about 5 years. You just, if you're going to take money, you're going to borrow money, you got to have a plan to pay it back. And so I would say there's a couple different groups of people. If I'm in that situation and I can't pay my mortgage and I'm upside down on my mortgage and there's no equity in my mortgage, I'm going to have to think twice about it. But on the flip side, if I'm having a hard time paying my mortgage and I love my house, but I got $100,000 worth of equity, this is not, in my opinion, this is not a bad option, because you're looking at the long term, and you're looking at you're going to take a hit, okay, with the withdrawal payment, but you're also protecting a nest egg.
So a hardship withdrawal, though, isn't a payback. It's not a loan. You're actually withdrawing these funds. You're going to pay taxes on it. It's an early withdrawal. So you're taking that hardship, and I believe it's like
okay. So I was getting
11,000
confused
max.
with
Yeah.
taking money out to buy a house.
Yeah, that's not a hardship. That's when you're actually
Taking a loan against
you're
yourself.
taking a loan against it, and then you're using it as a down payment on your
And
home.
if you're taking a hardship loan, or excuse me, if you're taking a loan against your 401k, I mean, it's the best place to borrow from, because you're paying yourself back interest. You're borrowing from yourself. I'm
totally cool with that. Right.
As
Then
long
you become
as,
the bank.
Yeah, you become the bank. And as long as you have a plan on, like, okay, this is how I'm going to make my corrections. Maybe you're taking that 401k loan to pay off other debts to reduce your monthly liabilities. Makes 100% sense there.
So guys like me, I mean, I've never had a 401k. My wife has. She's worked in corporate America. My 401k is real estate, right? And so, of course, that's what we teach here. That's what we practice here. So, walk me through a little bit of how do they define a hardship, like, and who polices that, or is it just kind of like one of those things you just submit you submit an application saying, hey, look,
He's going to call as Christine and say, hey,
Yeah,
I got a hardship.
yeah.
Can I take some money out of my wife's retirement account?
I feel like having an extra 10 grand cash. So, like, what does that look like?
So it's the servicer of the account. So one of the major ones is Fidelity, right?
Sure.
The Fidelity 401k. And basically you have to submit documentation to them. You write a letter of explanation and you submit this to them, and they decide if you're able to do that. Now, if it's going to purchase a home, they typically want to see a closing disclosure or a loan estimate to show what their cash to close is going to be, and then they can withdraw the funds. Typically, they'll get approved for that hardship. Now, I don't know what it looks like if you're actually running into some sort of hardship on what that letter looks like or what type of documentation you're supplying. But I based on how easy it is to get a hardship for purchasing a home, I have to believe it's just something as simple as a letter of explanation on, hey, we're having a hard time. My debt to income ratio is high, or I'm not able to make my payments. I'm trying to do this to avoid foreclosure.
All righty. If you are experiencing hardship and looking for options before you make any decisions, we'd love to have that opportunity to talk with you, talk you through some of these options. All you got to do is text the word IDEA to 623-AZ-RECON. That's IDEA to 623-AZ-RECON. So I want to spend a couple minutes talking about using your 401k to actually buy a house. I mean, and there's a difference. I have personally a problem if someone says, and this is kind of near and dear to my heart because I really want a fishing boat. I'm not sure that taking money out of my 401k to buy a fishing boat really is advantageous for myself and for my family. But being able to take money out, and I guess most of it is, on average, you can take 50% of your vested account balance or $50,000, whichever amount is less. But if I have the ability to take $50,000 out and put it into a piece of real estate that is going to appreciate, and again, I'm paying interest on that, but I'm earning that interest. I think there are great scenarios for that and great options for it. But what is the qualifying process like? I mean, I'm going to assume not every lender or not every underwriter is going to be good with it. And so if I'm in a position where I'm thinking about
Great question.
leveraging my 401k to buy a piece of real estate, before I start getting into contracts and things like that, what is it that I need to do?
That's a great question because I don't think we've ever really talked about that. When I worked at a big box bank, if you took a loan from your 401k, I would actually have to hit you for that on your debt to income ratio. And it would have an impact on what you qualified for. So what I would tell people is, if you're going to take a loan, do we have room for it? Okay, so we would determine if we have room for it, what that would allow them for in their monthly payments based on what we're looking at. And then I would always tell them, like, take the longer term loan because it's going to reduce your payment. The hardship, obviously there's no repayment to it, easy enough, but you're limited on the amount of funds that you can take. With where I'm at, Fairway, if you take a loan against yourself, I don't even calculate it into your debt to income ratio, no matter what type of loan you're doing, because you're paying yourself back. It's a loan against yourself. So what do we care about it? But I think it's brilliant to take money from your 401k in order to purchase another asset. Now, not a depreciating asset like a fishing boat. There's no chance in hell that I would tell you.
I think I can I've tried to make the case to my wife, and I think I can. I just haven't put it into a PowerPoint presentation that I think I can generate a lot of business by taking people out fishing all day on a Saturday and Sunday and drinking some beers. And she's not having any of it right now. And I haven't figured out how to hide that.
Shocker. I have no idea why she disagrees with me on that. That's
Mike would probably fall off the boat and drown if we let you do something like that.
Dude, I'll
Can you swim?
outfish you, dude.
Can you swim?
Oh, yeah?
Of course I can swim.
Yeah.
I can float.
You're going to outfish me.
I'm talking to him.
Oh, okay.
I wasn't talking to you.
I don't know. It depends on what we're fishing for. What are we fishing for?
Well, we're fishing. I'm talking about deep sea. I'm talking about yellowtail
I've never done
and
that.
the good stuff.
Okay. I thought
we're
talking about like trout and bass.
Yeah, I know you go to
I
know you go to Troutdale, the trout farm up there in Sedona, and
just dip it in and pull it out.
Yeah, use the bamboo stick. So going back to this though, I know we're kind of talking about hardships, but like let's talk to the people that have a little bit more, resources or a little bit more savviness when it comes to this. There's a lot of people that really strongly agree with what 401ks bring, and I do too, what they bring to the table, and there's a cap on how much they can put in per year, right?
Yeah, yes.
So that being said, wouldn't it be smarter to loan or pull out as big a loan as you possibly can, and then you're paying yourself back your maximum plus interest? You get where I'm going with this?
Yeah.
And you and buying real estate strictly off of what your 401k is, maximizing that as much as possible. Can you do it on non-owner occupied loans?
100% you can, because you're taking a loan. They're not asking you
Christine's
questions.
401k is about to be wiped out now.
It's about the flat line.
Obviously, the larger loan you take from yourself, though, the larger your payment's going to be. So,
Sure.
I mean, it cuts from the monthly income that you're receiving each month. So you got to really you got to feel that out and make sure that that's something that's doable.
I get
for
that,
you.
but if you're like, okay, I'm paying $10,000 a year, and I wish that it could be $11,000 a year. Go ahead and borrow that $10,000 from yourself, and then cap it again. But now you're also paying that 10% interest or 9% interest on top of that, and then it's just getting it's now jacked up from 10 to 11. Am I thinking correctly, or
you are? I mean, a 401k is more long term. Yeah, you are, and you're fine. The problem is most people, they get that first loan, and it was so easy. They take a second loan, they take a third loan, then they're maxed out on loans,
but then they have 4 income producing properties that are appreciating.
Well, if they go that route, that makes sense to me. Like I'm never gonna say you're doing something wrong by taking from from one asset to another one that's going to make you money. As long as it's making you money, I'm never going to say that. The real problem that we have with 401ks or any type of asset that you have is financial advisors. Typically, they're paid on the amount of funds that you have in your overall account, and so a lot of times they just don't like the fact that you're pulling funds from your accounts. But at the end of the day, to me, you're diversifying. You're also getting something that's tangible that you can reach out and touch. I like the diversification, and I love real estate, and especially here in Arizona, where we have this chip plant that's just blowing up, and we know that this is going to bring so much demand to housing. I would do it all day long. I would totally do it.
Well, what I heard, and I'm going to relay it to my wife, is Justin thinks that I should take money out and buy a fishing boat. So I appreciate that.
Yeah.
Yeah, because there's a discussion, alternatives to pulling money out of your 401k. Just go buy a fishing boat, and then you can have more clients and or more opportunities, and you will actually be making money. I think that's a fantastic business model.
Well, what I like on here, the alternative to pulling out money is, if you really are struggling month to month and you know that you're not able to get ahead, you have to reach out to these guys, or you need to at least stay in touch with the servicer. I mean, reach out to these guys first, and then your guys are going to tell them to call the servicer if they need to.
You have options.
You do. You have options, and it's just don't try to keep digging your hole deeper.
Yeah. All righty. If you are looking for options, creative options, or you've got a sizable 401k and want to consider the concept and the idea of possibly using it to buy appreciating real estate, we'd love to help you with you on that. All you got to do is text the word idea. Just stop staring at me, dude. I didn't even have a drink.
You didn't. I didn't even know what you said, though.
I didn't either. But either way, if you want more clarification from what I said, go ahead and text the word idea to 623-AZ-RECON. That's idea to 623-AZ-RECON.